But now let's bring in George Tsilis, senior markets correspondent here on the network. George, we're talking Amazon. It's had a pretty good run so far this year, outperforming. It seems like they're losing market share in cloud, but maybe stabilizing a little bit there. On the retail side, margins aren't going down anymore. What's your take here on Amazon?
I think this is an interesting company, obviously, interesting situation. I think at the end of the day, we have to sort of separate the e-commerce business, which we know is very convenient for consumers like myself who utilize it all the time, but it's also very costly. I think if you look at the core business for Amazon, which is the e-commerce, and separate the other elements to their business, which is really technology, I think that's where it becomes a little bit more interesting. Now, as you mentioned, Amazon Web Services was a leader in cloud. They are still effectively the largest market share component of the public and private cloud ecosystem, but they're losing market share to other cloud computing companies like Google, for instance, and not necessarily a bad thing, as long as, of course, Amazon continues to increase its revenue base. In this case, if you think about their e-commerce business, that actually increases the amount of traffic to their website, which then, of course, through Prime membership, which effectively has over 200 million subscribers, can, of course, add additional services, which includes like Amazon Prime Video, which also increases, of course, viewers and hits for advertisers. And I think that's another revenue driver that is also sort of underpinning Amazon's growth trajectory on a forward basis. So if you look at the core business, I think you have to look at the high multiple first. It's trading at around 60 times forward earnings. Its net income at around 2.4% is really in line with other retailers like Costco and Walmart. But at the same time, gross margins for Amazon are significantly higher because it's really a technology e-commerce company versus, if you will, a brick and mortar based business, let's say like Costco or Walmart. I think if you consider the ecosystem that Amazon has created and all the traffic that goes to their website, that's really a driver for growth, not only for cloud computing, which we know AI demands are going to be still there, especially growing forward into 2030 for hosting infrastructure software on the cloud. That's what Amazon does alongside with Google and Microsoft. But the e-commerce division really drives lots of traffic. It's not only the components of third-party resellers and, of course, Amazon direct-to-consumer sales, but also, if you will, the advertising revenue the company's going to be generating in the future. And I think that's one of the growth drivers a lot of the analysts are still seeing in this name.
George, there's a lot of interesting things going on at Amazon right now. But think about this, George. What would Amazon be trading? And I don't need an exact, just you can give me a higher or lower. If the FTC came in and said, we're going to break Amazon up, would the stock go down or up? I think it would go up sharply, right, on the pieces.
Yeah, I suggest if that does happen, that would probably unlock the multiple associated with the technology business. So therefore, one would assume that, it'd probably go higher. I think at the end of the day, a lot of times, in most cases, a lot of these FTC lawsuits essentially cause headlines more so than damage to the underlying company.
Yeah, and
absolutely.
If you look at this, retail sales, only e-commerce sales at Amazon e-commerce sales overall are still only 15% of the market at this point. So that's a big investment into
e-commerce is not going anywhere. AWS may have paused in its growth, but that opportunity is still enormous.
Yeah, they just invested $4 billion in Anthropic. George, is that the next spot where they hope they don't get broken up so they can work this AI investment in Anthropic into all their products, right?
Yeah, I think so. I mean, ideally speaking, they want to keep their technologies integrated, but at the same time, if they do end up getting broken up, I'm not saying they are, I don't necessarily think they will. They certainly would have partnership affiliations with the separate companies. I think at the end of the day, the entire brand, the Amazon brand is such a large ecosystem that essentially it carries through to multiple services across their e-commerce platform, but also, for instance, their Prime Video. Their Prime Video now is launching their advertising-based tier, but also if you want the non-ad tiers, you got to pay a premium, about $2.99. Now, that's not a lot of money on a consumer basis. They'll pay it, that can be a big driver of earnings for the company. I'm just going to use Costco as a quick example because Costco's memberships from the percent of total sales is very small, but when you look at it broken down in terms of net income, it's actually a large percentage of it. So my point is that any additional subscription-based revenue is really just a trickle-down effect to net income, which can certainly improve the prospects of the stock price.
All right, great stuff. Great breakdown for us, George. Appreciate that. That's George Tillis joining us, Senior Markets Correspondent